So these are three dividend paying stocks I like right now. Each of these stocks, I used a different valuation methodology to find a target price. And we're going to go over the target price I have on each of these three stocks. The first stock, I used a discounted earnings per share and a price to book valuation. The next stock, I used a discounted cash flow, a price to sales valuation, and an EV to EBITDA valuation. And the last company, I used a discounted cash flow, price to sales valuation, EV to EBITDA valuation, and a dividend discount model. So let's go over these different stocks and what I think they're all worth. Thanks everyone so much for watching. I do want to remind you, I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence. Let's start with our first stock. I'm actually going to go in order of dividend yield. So the lowest dividend yielding stock I'm going to start with here, this is this one, and we'll go up from there. And by the way, if you do like this video, please hit the like button and subscribe if you want to see future videos like this. Also, I have some affiliate links in the description below. If you want to support the channel, go ahead and check those out too. Thanks a lot for taking a look at those, liking and subscribing. So the first stock here is Bank of America. These are the dividend metrics for Bank of America. Now, Bank of America is the second largest bank in the United States based on market cap. The largest is actually JP Morgan. I went through an in-depth valuation of what I think this stock is worth. You could take a look at that video where I kind of go deeper, and you'll see in that video that Bank of America has a little bit more debt than JP Morgan, so you might want to take that into consideration if you're going between these two stocks, but I think that this stock actually turned out to be a little undervalued compared to JP Morgan when I got my target price. So what we have here is we have a dividend increase history of 8 years. We have a dividend yield of 2.32%. We have a growth rate in the dividend over the past 3 years at 13%, but if you go back like till 5 years ago, it's actually like 25% growth, and it's even higher if you go back further. So good growth in dividends for this, and it's got a payout ratio of 21%. So not a very high payout ratio. This is based on its earnings, so we don't have to worry about this stock like paying too much of its earnings out right now for dividends. So those are some of the dividend metrics for you dividend investors out there. Now let's go over and take a look at the price to book valuation. What I did for price to book here is, again, if you want to watch the in-depth video, you can. But what I did was I said the current price to book ratio, this should say price to book, not PS, is 1.22. Now, the median over the past like multiple years has been 1.24, and the average is 1.2. I used a 1.25 price to book ratio for here, and I get this. So I basically get a $37 price target growing to $44. Now, that's a 4.20% rate of return right now, growing to just a 4.2% rate of return by 2026 if you held it. But that's this valuation methodology. I got a better valuation when I did the discounted earnings per share for this company. So this is the weighted average. I got a discounted earnings per share for this company of $68 per share. So what I do is I say I'm going to use $68 per share. I'm going to use the price that's the discount earnings per share. I'm going to use the price to book valuation, $38. I'm going to basically split them in half, weight them, and I'm going to say, okay, the price target of this thing is actually $53 per share. Now, this is the target price for this year, the year of 2022. So this would end up being an upside potential of 46% if this was to occur. Taking a look at the technicals for Bank of America, this is going back till April of 2020, and you can see nice uptrend channel. This uptrend line here was actually the stock broke down through that channel line, the uptrend line, and into another downtrend channel, which it's currently inside. Now, I'm going to zoom in here so we can see this a little bit better. So I made my video about Bank of America. I had some different areas of support and resistance, and so it's right now getting really close to this little, let's call it a Darvis box here of $36.08. And I have this as some support potentially. If it breaks down through this, I have it potentially going to 31 and then having support there. So that would be staying inside this downtrend channel. It's good on terms of RSI. This thing is actually looking pretty great. It's essentially it's pretty much oversold right now. So 28, it's under 30. MACD is continuing to decline, and I don't see these oscillators getting any smaller yet. So what I'm thinking here is it could be a decent time to actually buy the stock at this level, given that it might hit some resistance here. So if you wanted to take a look and see if it bounced off this level, that's probably a potentially good sign if it does. The next company we have is Intel. Now, Intel is interesting because it's a semiconductor company, and a lot of times people consider semiconductors with growth companies, and Intel pays a good dividend. It's got a nice dividend yield, 3.23% as a dividend yield. It's got dividend growth over the past 3 years of 5.40%. Now, if we take the free cash flow of Intel and we say what is the dividend paid compared to the free cash flow, it's a payout ratio of 58%, a little high, under 60. So once it gets over 60, I get a little bit concerned. And then when you throw in share buybacks in there, so it gets up to 83%. So they're doing both share buybacks plus paying dividends. A lot of their money is going to that. So I would think that this is going to affect not the dividends paid, but I think share buybacks is probably going to be reduced a bit at some point because it's hard to pay that much money out in both share buybacks and you need some money left over to run the company, right? So let's move on to the price to sales valuation I got for Intel. So what price did I get using this methodology? So I took basically 2.42 is the price to sales ratio right now for the company. The median price to sales has been 3 and the average has been 3 over multiple year period. So what I did was I said, okay, what if we did a 3.25 price to sales ratio going forward? So that equals a $64 target price right now. That's 41% upside. Now, if we went down and we went a little closer to what it's currently at, 2.67, well, I get $54. It's still 20% upside. So to me, I think this stock has upside potential. I think it's worth more than it's selling for, especially according to price to sales. Now we go out to 2026. It's $84 a share. It's a 13.3% compounded annual growth rate. I mean, that's something that I think is pretty good. It should be over the market average. Now, if I value this company using enterprise value to EBITDA, so this looks a little bit different. So we have 6.9 is the multiple, the average multiple of EV to EBITDA for Intel. The median's 6.9, so they're both very close. That's good. So what I did was I gave it an actual EV to EBITDA that's under what it's currently at. So I did a 6.5 multiple. And if I did that, I get a 2022 target price of $54. That's 19% rate of return. Growing up until 2026 at 72. That's a 10% rate of return if you held this over time based on my calculations. And then we can look at the weighted average of these. So the free cash flow, so the discounted cash flow that I used, I get a price target of $50 per share when I did that. I'm weighting this one a third of the price, right? So a third. Price to sales valuation, I'm going to also weight that 1/3, so $64 per share. And then EV to EBITDA valuation, I'll weight it a third, and that's going to be $54 a share. When I add these up with the proper weightings that I'm giving them, it's $56 a share. That's 23% upside for this company. So I also think Intel is a undervalued stock right now. Intel's got a very wide range for its uptrend channel, so it's really gotten all the way up until the 60 areas and then down into the 40 areas. So let's zoom in real quick. So Intel is in a shorter term downtrend channel, which is still inside the uptrend, and you'll see it tested basically the uptrend line a couple times here, and it's looking like it's going to go back down and test it. This thing bounces off. Eventually, if it does bounce, we'll see if it is able to go a bit higher, but if it does break down through that, this thing could go a bit lower, so I would be watching to see if this does bounce off of this trend line. If it holds up, maybe it's continuing to be a good sign that Intel is not going to go below the 40 area anytime soon. If it does break down through it, we could take a look at this downtrend line, and we could look at the 40 area as well, where it might end up not going much further down than that. It is currently battling some simple moving averages, this red and this blue one, so we have that. Don't worry about this arrow is an old thing I wrote, so don't worry about that. But potentially I would watch, if I was going to time this one, I would watch it right here. Of course, if I'm just buying long term, I'm not trying to time an entry point. I think that Intel is a undervalued stock, so I'm liking that company. The final stock I have today is Verizon. So Verizon has paid a dividend, increasing history, 18 years. So it's been paying a dividend, it's been increasing it for a while. It's got a dividend yield of 5.28%. It's got a dividend growth of about 1.71% over the past 3 years. The free cash flow payout ratio is 62%, so a little bit up there, but it's not really buying back shares, so we don't have to worry about like the share buybacks going away, so that's not concerning to me. As a pretty stable dividend paying company and a company that has a pretty decent payout ratio based on its free cash flow, I think that it's okay to use a dividend discount model to do a valuation on this company. So I got basically a fair value using that methodology of $85 a share. It's currently trading at $48. So according to this valuation, it's 76% is the basically undervalued by 76%. So definitely a potential buy for this one. Now I will say that dividend discount model was the most aggressive price target out of all the ones I've done. So let's look at a more conservative, well, just a more like lower price target. So first we have the price to sales ratio valuation. So what I did here was I said, okay, median price to sales multiple is 1.78, average 1.78. Pretty confident going around that for a price to sales ratio. I went with a 1.78 price to sales ratio. I got a $58 per share right now in 2022, growing to 2026 at $60 per share. I don't have this company growing that much, so the rate of return over that time period is not quite as good, but when you do look at it in the shorter term, let's say 2-year time period, you're getting a decent rate of return with this stock. Now if I take a look at the EV to EBITDA multiple, basically I used about an 8 for this one, so here are the median and averages here. So I used an EV to EBITDA of an 8, 2022, it's worth 61.65, grows to 67.37. It's about a 27% rate of return in the first year, and then it declines till only 6% by 2026. So maybe not a very long-term hold, but we'd have to watch to see what happens with Verizon if there's any growth issues. Because I really had growth really declining fast in this one. So if it does end up having decent growth like in the next couple of years, then this would look better further out. So the weighted average of this, and I did also do a discounted cash flow. So for that one, I got a 25% of my target price is based on $66 for a discounted cash flow valuation. So that's what I got. The price to sales valuation was $58, EV to EBITDA $60, and then dividend discount model, more aggressive, $85. This gives me a $68 per share for Verizon. That's a 39% rate of return if this were to occur by the end of the year. So some technicals on Verizon. So we have it getting up to about $57 per share. This was back in December of 2020. And it hasn't been doing so well since then. It's been in a downtrend. Zoomed in a bit here, we could see that it went down as far as $48 per share. Yeah, it's had a run up back to this basically the parallel line of the uptrend, the downtrend channel, and so it got up to 55 again. Then this thing just really tanked. So it really went from the top of the trend line, looking like it was pretty decent growth over just a few months until hitting that top of the parallel channel, parallel part of the downtrend line, and then going all the way down to the bottom part of the downtrend line, actually hitting it. And we're going to see what happens here. Does this thing bounce off the trend line, or does it go down further? Now, some positives here is that RSI is also really way down here on the oversold area, so potentially good here. In terms of moving averages, they're sitting up here in the 52 area, so if we do zoom out a bit, we can see that there is some support area here. There was a decent bounce here, and then also the wick actually touched this, so 48 seems like a level that may hold as support. So we're going to see what happens with this one. But right now it's in a very interesting area. If it bounces here, it could definitely go back up, or it might actually break down through this area of support and it might go lower. So those are the three stocks I like: Bank of America, Intel, and Verizon for dividend paying stocks right now. I've done in-depth videos on all of those stocks. So if you want to take a look at those, I will leave a little link in the description, and take a look at that. And again, if you like this video, please hit that like button and subscribe to see more of these, and support me by taking a look at those affiliate links in the description below and watching the rest of my videos coming up right now.